Hello students, this is Professor Vincent Usaya. Welcome to my class. This is the presentation of Chapter 10, Auditing the Revenue Process. In Part 1 of this course, we talk about the introduction of assurance or introduction to assurance and financial statement auditing. In Part 2, we talk about audit planning and basic concepts of auditing. In Part 3, we talk about understanding auditing and internal control. In Part 4, we talk about start and not start sampling tricks or techniques used in auditing. Now, this is the last part of the course, and that is Part 5. Here we are zeroing in on auditing processes. Auditing processes, specifically Chapter 10, zero in on the revenue process. So let's go ahead and start off by talking about the definition of revenue. We said here that revenue is defined as inflows or other enhancement of assets of an entity or settlement of its liabilities or a combination of both from delivering or producing goods, rendering services or other activities that constitute the entity's major or central operations. Now what does that mean? In summary, every company does one of two things. You are either selling goods or delivering goods to customers, or you are providing services. During the course of engaging in that activity, you earn your revenue. The question becomes, how do we recognize revenue? The word recognition, another word for recognition in accounting, as you probably know by now, is record or recognition of revenue. Now, again, the key, a couple of key terms I want to draw to your attention is the fact that the activity the activity must relate to the main reason why the company is in existence in terms of considering it as a revenue. So again, we said it's inflows or other enhancement of assets of a company or settlement of its liabilities. Kind of tricky here, we said settlement of liabilities because you can provide services in exchange for settlement of your liabilities, and that will be that will also constitute earning revenue. Now, moving along, that as a backdrop, let's take a look at revenue recognition criteria. The Security and Exchange Commission Staff Accounting Bulletin 101 marshal out the criteria for revenue recognitions as follows. Number one, persuasive evidence of an arrangement exists. In other words, there is an evidence or persuasive evidence between the seller and the buyer. Number two, the delivery of the product has to occur or services must have been rendered. And number three, the seller price to the buyer is fixed or determinable. And number four, the possibility of collecting the amount from the revenue is reasonably assured. So these four criteria make up the recognition of revenue. So let's take a look at the fraud risk in revenue recognition. What are we talking about here? We said that a lot of companies engage in improper activities in revenue recognition. As a matter of fact, one of the biggest reasons why a lot of publicly traded companies restate their financial statement relates to inappropriate or recognition of revenue or recording revenue when the proper criteria are not met. So here are some fraud risks in revenue recognition. Number one, a side agreement. This is a situation whereby you made an agreement with the buyer, you are the seller, you make a special agreement with the buyer that is very unconventional with the intention of padding or increasing your revenue without a good cost. So for example, normally you ask your buyers to buy and pay back in 30 days. But at the end of the year, in order to pad your revenue, you say to some buyers, listen, we will give you 90 days or 130 days or 120 days, however the case might be, before you can make a payment. It's a side agreement and it is not consistent with your normal policy. So in such circumstance, you wind up recognizing revenue inappropriately. Another situation is a channel stuffing. What does that mean? Here is a situation whereby you encourage, a company encourages its buyers to buy more than what they normally would buy, perhaps towards the end of the year, in order for them to recognize more revenue. By so doing, you are shifting a revenue of subsequent years into the current year. Another game that some companies play is they engage with revenue transaction with related party transactions. Then the last one is bill and hold sales. A company will sell to the buyer, but the goods have not been delivered. All right, just a special arrangement and say, well, let's go ahead and complete this transaction anyway, but the intention is not to completely sell the goods. So those are the 4 different types of games that companies play in revenue recognition. None of them is in accordance with GAAP. Now, moving along, let's take a look at the overview of the revenue process. When we earn revenue or recognize revenue, we deal with our customers in one of 2 ways. We either sell them goods on cash or on credit. The cash sale is very simple, straightforward. What happens? We buy inventory and we sell in cash. So we pay cash for the inventory, we receive cash from customer case close. But for credit sales, the process is a little bit more involved. We spend cash or buy inventory on credit, then we put them on the shelf and look for customers to buy. The customers who buy on credit, then we go ahead and chase them around for them to pay before we eventually collect our cash. So as you can see, the credit sale is more involved than the cash sales. Moving along, types of transactions and financial statement accounts affected. What are we talking about here? Here are the transactions that relate to revenue recognition. 3 main transactions here, all right? And number 1, sale of goods or rendering of services for cash or credit. We just talked about that. Number 2, the receipt of cash from customer in payment for goods or services. So after we sell to customers, then hopefully and prayerfully we expect payment from the customer. That is another transaction relating to revenue recognition. Number 3, sometimes the customer will have to return the goods for credit or for cash. So those are the 3 main types of transactions that we engage in relative to revenue. Now, here are the types of transactions, but then the question is which accounts are affected. So take a look at the first one, sales of transactions. When we sell, which accounts or general ledger accounts are affected? Obviously, accounts receivable. So when we sell on credit, accounts receivable is affected because we debit accounts receivable and credit sales. Now, of course, sales account is also affected. The allowance for uncollectible accounts is also affected. As you know, allowance for uncollectible accounts is a contra account to accounts receivable. And of course, bad debt expense is the provision that we make for X amount of dollars that might not be collected from credit sales. So take a look at cash receipt transactions and sales returns and allowances. So we marshal out here accounts that are being affected. So the question is, why are we interested in knowing types of transactions relative to revenue recognition and the accounts that are affected? We need to know that because as auditors, if we don't have an understanding of the process or the type of transactions that normally occur and the accounts that are affected, of course, that will impede our ability to effectively audit the revenue process. So, moving along, let's take a look at the flowchart of the revenue process of this company. Now, this flowchart is very comprehensive. In order to understand the revenue process, some companies or some auditors will actually come up with a narrative description explaining the revenue process. Some auditors are more comfortable with using flowchart because it is very pictorial in nature, and that is what they are comfortable with. So here is a flowchart of the revenue process, and we are going to explain this in part 2 of this presentation.